These are 5 most actively traded bullish stocks we are covering. While watching bullish intraday price actions, let us inform you our review on NVDA. NVIDIA Corporation remains at the forefront of accelerated computing, delivering strong financial performance and expanding its leadership in artificial intelligence, gaming, and data center solutions. The company operates through its compute and networking and graphics segments, which power a wide range of applications, from AI-driven cloud computing to high-performance gaming and 3D simulation technologies. In its latest fiscal fourth-quarter earnings report, NVIDIA posted revenue of $39.3 billion, marking a 12% increase from the previous quarter and an impressive 78% rise year-over-year. A key driver of this growth was the rapid adoption of its Blackwell GPU architecture, which generated $11 billion in revenue, making it the fastest product ramp in the company's history. The compute and networking segment, which includes data center platforms, AI solutions, automotive computing, and robotics, played a significant role in this expansion. Data center-related sales surged 93% to $35.6 billion, reflecting the increasing demand for AI-driven computing power and cloud infrastructure. However, the company experienced a slight decline in gross margins due to the higher costs associated with advanced data center systems. The graphics segment also continues to be a strong revenue contributor, with GeForce GPUs driving gaming performance. The GeForce Now game streaming service expanding access to high-quality gaming experiences, and Omniverse enterprise software enabling businesses to build and operate complex 3D internet applications. Additionally, NVIDIA's professional visualization solutions, including Quadro/NVIDIA RTX GPUs and virtual GPU software, continue to support enterprise clients across various industries. Despite these record-breaking results, NVIDIA stock saw a decline of over 4% following its earnings report. Investor concerns were fueled by uncertainties surrounding potential tariffs and export controls under President Trump's administration, particularly regarding trade with China. Comments from the company's CFO highlighted the potential impact of new restrictions on NVIDIA's ability to conduct business in key international markets. Additionally, regulatory concerns have emerged, with Singapore charging 3 individuals in a fraud case linked to the unauthorized transfer of NVIDIA chips to the Chinese AI firm DeepSeek. This situation raises potential risks related to export control compliance and geopolitical tensions. Looking ahead, NVIDIA remains well-positioned to capitalize on the continued growth of AI, gaming, and cloud computing. However, investors should closely monitor geopolitical developments, trade policies, and regulatory challenges that could impact the company's long-term performance. While NVIDIA's technological advancements and strong market demand suggest continued momentum, external risks must be factored into investment considerations. Our review on LYG. Lloyds Banking Group continues to strengthen its presence across retail, commercial banking, and insurance, reporting a strong financial performance in 2024. The bank achieved £17.1 billion in net income and a statutory profit of £4.5 billion, alongside a 6% increase in digitally active users to 22.7 million. Shareholder distributions totaled £3.6 billion, supported by an ongoing share buyback program aimed at improving capital efficiency. In a major strategic move, Lloyds secured a £99 million contract with HMRC, replacing Barclays as the UK government's banking provider as part of a broader £334 million agreement. The bank also demonstrated its commitment to social responsibility by investing $63 million in Prince William's Homewards project, supporting housing initiatives for vulnerable individuals. Operational changes include the closure of 136 UK branches and the outsourcing of 400 Glasgow jobs to Teleperformance, aligning with the bank's shift towards digital services. In line with this strategy, Lloyds appointed Natasha Sayce-Selam, former global head of partner engineering at Amazon's Prime Video, as Director of Digital and Business Platform to drive innovation. Despite economic and regulatory challenges, Lloyds remains focused on digital transformation, shareholder returns, and community impact, positioning itself for continued growth in the evolving financial landscape. Our review on TRNR. Interactive Strength Incorporated is making significant strides in the connected fitness market with its CLMBR and For Me brands, offering innovative fitness equipment and digital services. CLMBR is a vertical climbing machine with a large format touch display and on-demand, instructor-led classes, providing users with a full-body strength and cardio workout. CLMBR is available to consumers directly through its website and is also offered to businesses, including gyms, fitness studios, hotels, and physical therapy facilities. Meanwhile, For Me is a premium digital fitness platform that provides an at-home fitness experience through connected hardware products like the For Me Studio Fitness Mirror and the For Me Studio Lift, which adds cable-based digital resistance. Form's platform offers a variety of personal training options, including video on demand, custom training, and Live 1:1 virtual personal training. The company has demonstrated impressive financial growth, with Q3 2024 revenue reaching $2.01 million, a substantial increase from $0.306 million in the same period in 2023. Net losses narrowed to $7.14 million, an improvement from the previous year's $10.41 million loss. For the first 9 months of 2024, Interactive Strength generated $3 million in revenue, compared to $0.779 million in the same period in 2023, reflecting a solid upward trajectory. A major catalyst for growth is the company's acquisition of Sports Tech, a connected fitness equipment business generating over $40 million in revenue. The acquisition is expected to push Interactive Strength's total revenue beyond $50 million in 2025, expanding its reach and providing access to a broader customer base. Additionally, the company secured a 6-figure repeat order for CLMBR from its German distributor, which highlights strong demand in Europe, one of the largest fitness markets outside the United States. These developments have sparked a surge in Interactive Strength's stock price, reflecting investor optimism regarding the company's growth potential. Investors should closely monitor the integration of Sports Tech and its ability to expand further in international markets, as these initiatives are critical to sustaining momentum and achieving long-term profitability. With its innovative products, expanding customer base, and growing international presence, Interactive Strength is well-positioned for continued success in the competitive fitness industry. Our review on Ford Motor Company continues to evolve with its diverse business segments: Ford Blue, Ford Model E, Ford Pro, and Ford Credit. The Ford Blue segment handles traditional internal combustion and hybrid vehicles, while Ford Model E focuses on the development and sale of electric vehicles, EVs. Ford Pro serves commercial customers with vehicles and services, and Ford Credit manages vehicle-related financing and leasing activities. Recently, Ford CEO Jim Farley confirmed the company will exclude advanced self-driving features from its upcoming low-cost EV models. Instead, Ford will focus on offering affordable hands-free driving features on highways, making the transition to electric vehicles more accessible to a broader customer base. The company also faces potential disruptions due to U.S. tariffs on the auto industry, but it could benefit from new trade agreements with Canada and Mexico. Additionally, Ford's recent trademark filing for Mach 4 has raised speculation about a new four-door Mustang, which would align with the brand's performance image but might face opposition from traditionalists. Leadership changes were also announced to accelerate Ford's Ford Plus plan, aiming to transform the company and create a more dynamic product and service model. Following the 2023 United Auto Workers (UAW) strike, Ford reached a tentative agreement that includes higher wages, eliminating the two-tier wage system, and securing long-term labor stability. This may help avoid future labor disruptions and improve employee relations. With its strong push into EVs, ongoing product innovation, and efforts to maintain labor peace, Ford is well positioned to navigate the changing automotive landscape. Investors should pay attention to the company's ability to execute its electrification strategy, manage trade risks, and capitalize on market opportunities. Our review on PMAX. Powell Max Ltd is a holding company based in Hong Kong that specializes in providing financial communications services tailored to meet the needs of corporate clients and their advisors in capital markets. The company primarily supports businesses in complying with capital market regulations, ensuring that they meet their transaction requirements and fulfill the necessary compliance obligations in Hong Kong. Powell Max's service offerings include managing financial disclosures, preparing regulatory filings, and providing strategic communications for IPOs, mergers and acquisitions, and other significant corporate events. The company plays a crucial role in ensuring that its clients navigate the complexities of market regulations with efficiency and transparency. Recently, Powell Max has been actively pursuing a strategy to expand its market presence through acquisitions. The company has entered into an agreement to acquire Miracle Media Production, which will enhance its service offerings and create synergies that could result in a broader market reach. This acquisition is part of Powell Max's larger strategy to increase its footprint in Hong Kong and across Asia, aiming to serve a wider range of clients and strengthen its competitive positioning. In addition to the Miracle Media Production acquisition, Powell Max has announced an acquisition strategy focused on securing companies with annual revenues ranging from $1.5 million to $5 million. This targeted approach will allow Powell Max to scale its operations effectively and enhance its capabilities in the financial communications industry. By bringing in smaller, revenue-generating companies, Powell Max aims to achieve economies of scale and increase its market share, positioning itself as a leading player in the sector. To support its ambitious growth strategy, Powell Max secured a committed equity line of credit worth up to $40 million in November 2024. This financing will provide the company with the necessary capital to fund its acquisitions and continue expanding its service offerings. The access to additional capital significantly strengthens Powell Max's financial flexibility, enabling it to pursue further acquisition opportunities and scale its operations at a faster pace. With these developments, Powell Max is positioning itself for substantial growth in the financial communications sector. The company's focus on expanding its client base through acquisitions and enhancing its service offerings should enable it to capture a larger share of the market. Investors should closely monitor Powell Max's ability to successfully integrate its acquisitions, manage an increasing scale of operations, and adapt to competitive pressures in a rapidly evolving market. Additionally, the execution of the company's expansion strategy, combined with its access to significant financing, makes Powell Max an interesting company to watch as it seeks to capitalize on opportunities within the financial communications industry in Hong Kong and across Asia. Please subscribe and like the video. Thanks.